We are here to answer a critical question. How do we transform the Treasury from a regulatory necessity into a strategic engine for profitability?
A treasurer, while dealing in the currency, he will be dealing with multi-currencies, and in one currency he would have bought more, and in another currency he must have bought less, but the use of intervention of the Indian rupee or with the intervention currency of another foreign currency. So there may be a foreign currency transaction of buying loss is a loss known as resulting out of the currency risk. And the currency risk takes place due to various factors, economic factors, which I will not go into detail because here we are focusing on the treasury one. So due to variety of factors, the currency valuation undergoes a change and thereby creates a risk for the treasurer. Keep it next day and these vegetables are perishable, just like the risk that we have. So therefore, there is a likelihood of loss. So therefore, he tries to see the same logic here comes that the foreign exchange that has been ideally that is there, but in regular practical operation, there cannot be a identical match for a bought into a sale transaction. Therefore, there will be a kind of a leftover, one is more than the other, which is called the position. Due to day-to-day operation, the transaction go on continuing because till the business hours are closed, transaction continue to be there, then cover operations also good. So at the end of the day, but if you limit this kind of exposure, what will be the volume that the can take? So that is a overnight end, that is at the end of the day, my exposure should not be more than 250 crores in an example of 1000 crore tier 100. If this is the case, is it that I will operate only with 250 crore only and see that the keep is open? No, there only it comes how much operation that you can take. Is it because this kind of a 25% may not be adequate to meet the customer's requirement also. So there will be a kind of a higher freedom for this. There it says that this swap will be done either with, they can sell it to the Reserve Bank or they can do the swap transaction from the Reserve Bank or they can do it with the other bank who are authorized dealer in that. And this kind of exercise is also provided by the market makers or the foreign exchange brokers who are in touch with various banks, tier 1 and tier 2. Similarly, it doesn't have overnight open position of more than 25. Subject to these walls on both sides, operations are allowed to have freedom of the treasurer or the manager of the currency. Next one, please. Yeah, this is after the introduction of the gift city, we have got our own foreign country within the country. The gift city is in the nature of a foreign country so far as the foreign exchange transactions are concerned. So if many of the banks have got their own branches in the gift city, not only to fund the credit requirements of the operating units in that, but also to take advantage of the global market situations prevailing in other interbank transactions as also foreign exchange, foreign markets through the operation of this. And here, a special instrument is used which is called non-deliverable derivative contracts. These non-deliverable derivative contract, in the normal derivative contract, there is a settlement take place. On the settlement day, there is an exchange of currency that is taking place, and by that, the transaction is closed. Whereas in the case of a non-deliverable derivative contract, not the value of that, but exactly the difference in these two, the booking rate and this actual rate of closure, that is settled in Indian rupees. But that is expressed in crores of rupees for easy. And there also the balances, the transactions are classified into foreign currency versus Indian rupees and foreign currency into this. If they are maintaining a kind of technique like value at risk method, then that is also to be reported to the Reserve Bank. This is being monitored on a day-to-day basis at the Financial Market Division. Next slide, please. Yeah, this is the maturity mismatch. Generally, it is in month basis, wherever these maturities of transactions are not equal or squared off, there is a kind of a gap is developed, and this is also monitored to take care of the aggregate gap limit prescribed by the Reserve Bank. Next slide, please. This is the general balance of statement. This is currency-wise, country-wise. This is cent. So that this is also cross-checked with the R rate and balances to confirm the correctness of that. This is also seen how the balances overseas are deployed, and these balances, are there any high cash balances are kept? If that is so, that is being taken up with the respective bank. This is also being monitored. Next, please. These are all mostly for statistical purpose.
Master account.
Obviously. Vastu account.
I think you can suggest.
Yeah. It is a kind of a foreign currency assets in India.
Okay. That is a very important issue.
Yes.
I think we should.
Because those banks which are keeping this account, this is due to that.
But had there been no rupee Master account, there would have been Nostro account balance.
Yes. No, see, had there been another Vastu account, which a overseas bank can have any kind of Vastu account, but here it is exclusively for trade settlement. So here, whatever excess balances are there, these are assets for the overseas bank in Indian rupees, just like we having dollar balances outside India. So therefore, as you say, the Reserve to that extent does not recognize this.
Or if we are having positive balance in the rupee Master account, means it is they are balance with us.
Yeah.
So their balance with us, it cannot be our foreign exchange reserve. No?
Yeah, it will be a liability to pay.
It's a liability for us.
The liability.
That way, our foreign exchange reserve will be overstated.
Yes, it will be overstated. Both ways, it will have an impact on the foreign exchange.
Whether it is positive or not. Normally, it is positive. Yeah. Rupee Master account balances negative only in rare occasion.
Unless they have got a separate overdraft arrangement, in which case they will come from the regular Vastu account and not using the special Vastu account. Is mainly credit comes from the importers of India. They pay.
Now, how much it will be able to sustain with the reserves and regulations? And the US of late is trying to behave like a big brother and trying to twist anybody only because of the strength of the dominance of dollars. So let us see, as you rightly said, it is a remote area, but let us see how the development takes place. Right now, what your views is I agree with you. It's really very comprehensive view. But let us see how the development takes place in the international market. Arvind, over to you.
Thank you, sir. Actually, the discussion was very much relevant to the topic also, but audience people, they were waiting for the questions, so I had to request you. So our first question will be from Mr. Jacob Leverett. I just wanted to tell you that he attended some of our webinars earlier, and now he has taken regular membership of the club. And he is a senior quantitative risk analyst with Handelsbanken, with headquartered in Sweden, and this bank is having branches all over Europe. So now I request Mr. Jacob for his question.
Thank you so much, and thank you for the very kind introduction. So I think my question, because I mean here we have talked about sort of how to deal with the sort of FX part. In particular, you have your assets, quite clear how you slot them out. You have your liabilities, quite clear how to slot them out. But I would ask about the third part, which is the equity. So how to deal with equity? Because if I give a very simple example, imagine that you have two separate banks. Bank A operate only in currency X. Bank B operate also very interesting.
Thank you.
Just to supplement something, most of the cases it is found the foreign banks, those who are operating in India, or for that matter in other jurisdiction, their capital base is low. Since capital base is low, so 25% of that capital base, which is the open position limit, is also low. That's why they face sometimes this problem. What central bank is arguing is this is prudential in nature, number one. Second thing is don't keep this open position uncovered.
Yes.
Or risk management perspective. This is very simple because here there is no question of say discriminating between foreign bank or domestic bank. So your capital base is low, your risk management capacity to absorb the risk is also low. So you have to remain low. And if you are taking position, because most of the foreign banks export import activities are very high. So export import is there, that will balance. But open position, 25% of the capital is a small amount. If it exceeds 25%, go for cover.
Another thing what happened, Boy, as you rightly said, the aggregate gap limit is 6 times of the tier 1 and tier 2. So the leveraging option or opportunity is much higher. So, and the market is providing some kind of a profitable situation. The exposure goes by availing that 6 times the limit. At the same time, the cover of 25% is becoming very small. So I am exposed to a greater risk. Therefore, I find it, one, I cannot overnight increase the capital of tier 1 and tier 2. It is not possible.